Hey guys, my name's Henry. Welcome back to the channel. Yes, the title is true. I'm going to explain to you exactly how you can 10x your portfolio no matter how small using call options. I'm going to explain what call options are briefly, why they're so useful for a small account, and then give you some examples on exactly how you can double or triple your account using call options. There's a popular misconception that 90% of all options expire worthless. This saying frightens investors into mistakenly believing that if you buy options that they're always going to lose money, or at least 90% of the time they're going to be losers. I'll debunk that myth later in this video and tell you exactly why buying call options can actually be a very smart idea. When you buy a call option, you're essentially gaining control of 100 shares of stock without having to put up your money for 100 shares. So say you're very bullish on a stock like Apple, Tesla, or whatever the stock. Well, if you had to buy 100 shares of Tesla at the current price levels of $650, then that would be a $65,000 investment. Most people don't have $65,000 just laying around. Well, check out this image. With $3,150, you can actually control the same 100 shares. Let me step back and explain to you exactly how all of this works. When you buy a call option, you pay the option premium in exchange for the right to buy shares at a fixed price, the strike price. That happens on or before a certain date called the expiration date. You can think of the strike price like the price you're betting the stock will hit. You can think of the expiration date as the amount of time you have for your bet to work out, otherwise the option expires. Here's a quick example. Say we take Tesla call options again. You can see here that I picked May 21st. It doesn't matter what month you're in right now, it works the same way regardless. Say it's currently April 21st and we're 30 days away. What that means is you have 30 days for the stock to reach the strike price you can see here. If the stock rises towards the strike price fast enough, you can always sell your option anytime during the market open hours for a profit. Otherwise, I usually recommend holding till at least the last week before the option starts losing value quicker to see if your thesis on the stock plays out. On expiration, if the stock is above your strike, congratulations, you have made money. If it is below, the downside to buying call options is you can lose the premium that you paid for the option. Here's a chart of what your payoff would look like. We know your strike is 750, but let's go to the image one more time. Notice how it says the break even is $781.43. For us, it's going to be $781.50, and what I'm doing there is I'm adding the premium of what we paid for the option on top of the strike price. Because even when the stock hits the strike price you're betting on, you only profit after the stock has gone up enough past what your strike price is plus the premium that you originally paid for the option. So your real goal with this example would be for Tesla to hit $781.50 per share until you start to make real profit after expiration. Of course, if the stock goes up in the meantime, you will be making profit that you can take off the table at any time you wish. Here's an image of our examples side by side with a stock. You can see on the right-hand side, a stock makes money linearly, meaning it goes up $1, you make $1, and vice versa, it falls $1, you lose $1. Now let's just focus on the call option for this example. This whole area below the yellow dot that says break even, that's where you're losing the amount of money that you paid because the option has not touched your strike price yet. Again, this is at expiration. The way the option behaves in between is a lesson of its own, and it's very math heavy. I can do a simplified video on it if you hit the like button real quick and subscribe so I know to make that video. The maximum you could lose is $3,150 and not a penny more. If for some crazy reason Tesla fell to $0, I don't know why that would happen, but let's say it happened, investors would lose a total of $65,000 if the Tesla stock price is currently $650. However, holding Tesla options would only make you lose $3,150 of what you paid for the premium alone. And you still get to control 100 shares, but you have way less risk on the downside. I hope you can see where I'm going with this, and as you can see, aggressively growing a small portfolio is very possible with very little capital when you use call options. Now, very important because I want you to be able to calculate how much money you're going to earn and at what level you can double, triple, and quadruple, and potentially even 10x your original investment. Notice how you lose money in its horizontal line of the premium that you paid for the option below $750. You can see that by looking at all of these prices, $740, $730, $720, and so on, you lose the maximum of $3,150. You are still down $3,150, but now we have an inflection point at which things start to change. The call option starts to behave similar to stock, as I've mentioned. It moves up in price just like a stock would. So if Tesla ends at 760, well, our strike price, if you recall, was 750, so we have made $10 on the option, or since each option represents 100 shares, a $10 gain is really a $1,000 gain. At the inflection point, we were down $3,150, but after being $10 in the money, we're actually down $2,150 at this point because we're now making some money on the option. However, it did not reach our break-even price, so we have only partially recouped our investment when the stock reaches $760. We hit our actual break-even point at $781.50 right here. This is the point where you can wipe the sweat off your forehead and take a deep sigh of relief because it's all gravy from here. Now you can just continue to ride the gains. If the stock is at $782.50, you have made $1 in the option, or again, since each option is 100 shares, you have really made $100. At $783.50, you have now made $200. At $784.50, you have now made $300. So now I'm going to ask you a powerful question and then show you the answer, which will bring you the aha moment of how call options can really make you rich if you do it right. The question is, at what price do you double your money? Pause the video if you need to. All right, we initially paid $31.50 per contract, or $3,150. Our break even is $781.50. For us to double our money, we need to profit double what we put in. We need $6,300, which is double the original investment. All we need to do is take $6,300 or convert it back into the option contract of $63 and add it to our strike price of $650. So when you add the two, you get $713, and this is the point where we actually double our money. The stockholder would need the stock to go from like $650 all the way to $1,300 to double their money if they're just a stock investor. However, if you're an option call investor, then you have doubled your money at $713 in this example. Now, if you want to quadruple your investment, all you have to do is take your premium and quadruple it and then add it to the strike price. So for a quadruple times $31.50 would be $126. If you add that to $650 strike, now you get $776 to quadruple your money. Notice how it grows so quickly after your break even because the amount that you invested is so small when it comes to call options. To 10x your money, you multiply $31.50 by 10 and add that answer, which is $315, to the strike price of $650 to get $965. At $965, you would 10x your original investment. Isn't that remarkable? Investors who just buy Tesla stock at say $650 would only about 50% their return if the stock went to $965, but for a call option buyer, they would actually 10x their money. Now I'm going to draw a chart on my whiteboard behind me so you can see an exact example of the strengths and weaknesses of the strategy and how you can best use it to grow your small account quickly. All right, so here we go. We have call options. These are gains right here. On the y-axis, we have gains, how much money you make. That's why I put 0 right here. And this is the stock price. So currently, let's say we have a stock at $100. This is not going to be the Tesla example. This is going to be a simplified example because I want to solidify this knowledge for you guys and I want you to really understand how call options work and the strengths and weaknesses associated with them. Okay, so say we have a call option that is $5, okay? So that's the call option. And let's say it has a 100 strike, all right? So I'm gonna write 100 strike right here. Okay, so that's why I put $100 here, and the premium is $5. So right off the bat, if you're gonna be buying call options, you have to pay this $5 right here. So when you pay $5, well, you're obviously down $5. So you always start off right here, and I would put -5 right here, and you are at -$5. If the stock were to go down to $0, like I told you in that Tesla case scenario, which would never happen, of course, but if the stock was $0, the stockholder would lose $100. However, as a call option buyer, you will only lose the $5 that you paid for the option. So you're always starting here at $5. So even if the stock is, let's say, $20, you're -$5. If it's $30, you're still -$5, okay? No matter what, you're gonna be at -$5 up until the point of our inflection point at 100, because 100 is our strike. That's where we can actually start making some money, or at least getting ourselves out of the premium that we have already paid and getting closer to our break-even price. So right here at $100, something really interesting happens and we are no longer going to be at this horizontal line. We're gonna start moving upwards, okay guys? So here's -$5, that's the most you can lose. Now, if the stock were to be $105, then we would actually be breaking even. The reason is because if you add the strike price of 100 and you add $5, you have $105, and now you have officially broken even. So here's what happens. You start moving up, boom, okay? So at $101, you're still gonna be losing $4. At $102, you're still gonna be like right here, losing $3. You're breaking even, you're going closer to break even as the stock moves from $100 to $105. Now, what happens after $105? Like I said, it's all pretty much gravy from here. You're going to be moving upwards. So let me give you an example. So if the stock ended at $110 right here, if you take $110 and you subtract your break even of 105, you have a $5 profit right here, okay? Since you have a $5 profit and you've only invested $5, you have actually doubled your money at 110. Again, the reason why you double your money is $110 minus $100 is 10. That's your strike price, but you've obviously paid $5. So you have a total profit of 10, 110 minus 100. You know, obviously it's $10, okay? But you've only invested $5. So, you know, obviously 10 divided by 5, you get 2, okay? So that is the whole math to call options. That is the strengths of call options. Here you can double your money, and you know, obviously you guys can probably guess at what point would you triple your money. All right, so if you want to guess at what point you tripled your money and you didn't guess yet, go ahead and do that. But otherwise, I'm going to tell you the answer. It is $115. The reason is $115 minus 100 is 15. Now 15 divided by 5 is 3. So you have tripled your money at $115. Now guys, you're going to ask me, why don't more people buy call options? Well, the risk with call options is that you can lose your money. So for example, if you bought a stock and it's at $100 and it stays at $100, well, you don't actually make any money, because if it doesn't move, you know, as stockholder, he won't lose anything. He just has the same value that he's had at $100. But if you're buying call options, you have lost $5 below 100, or at 100, you have still lost $5. At 99, you've lost $5. Even at $104, or even at $105, you have only broken even when the stockholder has made some money. So call options have the strength of growing your money fast if the stock has movement. You need to pick a stock that has enough movement, so if it does go up, you can make a tremendous amount of money. But if you pick a stock that doesn't go up, or it doesn't do too much in the era or the time period that you have picked, then you're not going to be making a lot of money. And sometimes if the stock goes down or it doesn't go anywhere and it just stays pretty balanced at $100, you will lose the premium that you paid. Therefore, buying call options can be risky, especially in a market that is moving sideways or maybe even a little bit down, because if you buy enough call options, you will lose all of the premium that you paid, which is why I tell many investors that they should have a mixed strategy of buying call options as well as a stock portfolio, selling put options, which I have a video on that you can watch right here, and many different strategies that you want to incorporate in a balanced and diversified portfolio. But buying call options is one of the fastest ways where you can grow your portfolio very quickly, especially if you pick stocks that have enough volatility and these stocks end up moving in the direction that you want them to, which in the case of buying call options is going upwards. This video is an example of a video that I have in my weekly Option Income Academy. This is just one video. I have 80 videos over there, which is a very structured program teaching you exactly how to make money weekly using options and primarily selling options so you can profit. I also show charting analysis. I show you when to get in a stock, when to exit a stock, and many more different examples in live trading examples that I have gone over in my personal portfolio. So if you want to check that out, there's a link below to my weekly Option Income Academy. I put a lot of work there, and basically my whole mission in life is to teach other people how they can be financially free, they can make consistent income online, and they can live a more freedom-based lifestyle so we can be more happy and focus on the things that matter, like health, love, and relationships. Thank you so much for watching. Make sure that you check out my option playlist right here. I have so many more positive videos if you want to watch more free videos, and if you want the paid program where I show you exactly how to get a shortcut into making quick profits in an easy to follow course, then you can check out the link below.